And this is going to finish off Chapter 7 today. The other thing that I want to mention is I'm going to be putting up the little research project that I talked about last time. I'll do that this weekend so you can start to see that. Okay, and that'll be due like last day class or something like that. But basically, I'm going to ask for a citation as to what the FASB rules are regarding accounting for loan loss, accounting for allowance for doubtful accounts and all that, if that includes future loans or not. And I think we all agreed what? No. Okay, that's obviously nonsense, but I want the citation. I want the citation, and then I'm going to ask you to tell me if you think there's been any changes in GAAP, and then I'm going to ask what your overall opinion is. So I'll set it up like so-and-so said this, and give me the citation as to what the answer to that question is. You'll see it, and I'll put that up here pretty soon. Okay? Question? Okay, so let's go ahead, and my recollection was we had just looked at these couple multiple choice questions before we adjourned last time. So we're going to pick up from here with these slides. I'll post the marked up, completely marked up version after I'm done with these last slides. Please, my reminder, people remind me, to do that so I save that at the end of class, okay? Okay, so we'll finish the slides and then we'll do the quiz. So for Chapter 7. So let's go ahead and take a look. And we've got this company now that's going to issue a short-term note. Okay, short-term note meaning it's going to be more than less than what? 1 year, 1 year or less, I guess is the better way to say that. Okay, and we want to see what happens when they take a note. The note has an interest rate on it, and that is in exchange for the sale. Okay, so we have a $700,000 sale. It's a 6-month note, and it has a 12% interest rate. Now, you may not think of it this way, but this is a variable consideration transaction in that we have what? We have the sale, but we also have the interest component, and we're obviously going to break those two into their variable components. Okay, so when we first set the note up, we debit note receivable, we credit sales revenue for $700,000. Now it's a 6-month note, so it becomes due on November 1st. So what happens on November 1st? Well, on November 1st, they're going to have to pay the $42,000 of interest as well on that note, aren't they? So we'll debit cash $742,000, we'll credit interest revenue $42,000, and we will credit the note receivable now because they're paying off that initial note, right? So if you look at it from the overall transaction perspective, we did break the revenue from the sale into the interest revenue component, right? Okay. Now that's a short-term note, a 6-month note, which the note was signed during the year and matured during the year, right? If you have a situation where the note is going to be signed during year 1, but it's going to go into year 2, for example, we sign the note on what? August 1st, that note won't mature until what? August, September, October, November, December, what? January, the end of January that next year. Okay, will probably be paid February 1st, whatever. And so what happens? At December 31st, notice you would have to accrue the 5 months of interest that would have run. All of August, all of September, all of October, all of November, all of December. That's 5 months of interest that would have run, right? You have to accrue that at year end. And then when the note matures, 6-month note matures December 31st / February 1st, we would have to go ahead, we'd collect the cash at that point in time, go ahead and take our interest revenue now for January, just the 1 month, and of course credit the interest receivable. That was the August through December interest, and then credit, of course, the note receivable for the principal, right? Okay? Okay, good. Now you come over, and what happens if it is a short-term note, but it says it doesn't have any interest? Now, this is an easy mistake to make. You see something that says, oh, there's no interest on that, so you don't calculate any interest on it because the stupid thing said it's no interest. Meanwhile, in accounting, at least in the United States, we say that it's what? You don't borrow money over time and not have there be an interest component, right? So even if it said it was a non-interest bearing note, you would still have to figure out what the interest on $700,000 of sale would be if it did have an interest rate. So you would have to, and you'd have to figure out what the interest rate is for similar notes of a similar risk, etc. If it didn't tell you the interest rate, in practice, you'd have to do something called interpolation of the interest rate. You'd call around to different banks and that sort of thing and try to figure out what an appropriate interest rate is for it. So since the face of the note is 12%, we would take that 12% times the 6-month note and we would set up something called a discount on note receivable. So we would credit that discount, and then the difference between the amount that you've calculated as the discount on the note and the face of the note is going to be the component that is going to be the sales part of that. Remember, variable consideration, or not variable consideration, but what? Multiple obligations, more than one obligation here, and that we have the interest component and we have what? We have the sales component. You have to allocate the price between the two components, right? We've got two different things going on here, the borrowing of money and earning revenue over time on the interest and the sale. So you set that up as a discount. Okay? Now, what happens? On the balance sheet, we'll show note receivable of what? 700,000, and then we'll report that discount. The discount is a contra to the note receivable of 42,000, so that the net, that says net, so that the net note receivable will be 658,000, right? Okay. Now what happens? You come to the time when the note matures, and when the note matures, you will debit the discount and credit the interest revenue now because time has passed and you can recognize that portion of the revenue, right? And of course, you'll go ahead and you'll debit the cash and you'll credit the note receivable for the face of the note. Question? Okay, now, if you get to the situation where the note is signed, and again, like we had said before, the note is signed in August instead of whatever it was on the other one where it matured during the year. Instead of May, it's signed in August, and so now it's going to cross over years, isn't it? So at December 31st, you would figure out how much interest had accrued up to that date, which would have been 5 months, right? And you can go ahead and credit the interest revenue, and you debit the discount on note receivable. So the discount would have done what? If we had originally sat there and credited the discount on note receivable for 42,000, now we have debited it for 35,000, so it has how much left as a balance? $7,000 as a balance, right? Okay, so at December 31st, you recognize the interest for the 5 months by taking the interest revenue, debiting the discount. And then when you get to February 1st, you're going to go ahead and debit the discount, credit the interest revenue now for the 1 month of interest that you've earned now in the new year, whatever it is, 2019 in this example. And of course, you debit the cash, credit the note receivable for the face amount. Okay, so even if it says it's a non-interest bearing note, you still have to calculate the interest revenue portion of that, right? Regardless of whether they give you they'll have to give you the interest rate to do those calculations, but the note itself may be a non-interest bearing note, and so you may have to do some research if you're actually doing this in practice to figure out what an appropriate interest rate is for this note. Okay? Okay, good. Now, you come over and you take a look at long-term note. Now, when we get into long-term note, we have to start considering the present value. We have to start considering the time value of money because it is a longer-term note. And so you look at this example, and they say that this Stidwell Wholesale Shoe Company manufactures athletic shoes that it sells to realtors, whatever. On January 1st, 2018, the company sold shoes to Harmon Sporting Goods. Stridewell agreed to accept a $700,000 two-year note in payment for the shoes. Assume a 12% effective interest rate. Stidwell would account for this note as follows. And you see that they're giving us the discount on the note receivable. They're giving us the amount of sales revenue. Again, trying to break it into the two different contract obligations here, the interest portion, the borrowing portion versus the sale portion. The question becomes, where do we get this 141,964? Okay? Well, what you would do is you would figure out the present value of this note, and they tell me it's what? 12% over how many years? 2 years. So I just stuck in a little present value table in here. It's 2 years and it's what? 12%. Thank God this table had 12% on it. If it had gone any higher, I would have had to have gone to another table. But I can use that table there, which is giving me this number 0.79719. You see that number? Okay, so what I'm going to do, I'm going to just go back and put it over here. I'm going to take the 0.79, what was it? 791, like that? 719. That number? Okay, and I'm going to multiply that times the 700,000, which is the what? Is the future value of what I'm going to have to pay off on that. So to get the present value, I get this 5580 and I think it's 33 whatever, but we're not going to argue over $3. Probably they had a different table. They had carried it out one more decimal. Okay, I'm not freaked out over $3. Is that the present value of that note? Okay, so what I do is I credit the sale for just the present value. I mean, mathematics of finance says I would have been just as happy if that person would have coughed up $558,036 cash today, right? But they didn't. We took a note, right? And so some of that is interest, okay? So now we have this 558036. Now this is a 2-year note. It's a 2-year note, so at the end of year 1, we're going to have to recognize some interest revenue, aren't we? So we take that present value, the carrying amount of the note, 558036. Back up for a second. Let me show you the balance sheet at January 1, 2018. 1/1/18, the balance sheet. We'd show the note receivable what? Gross, 700,000. We report the discount. The discount is this 141,964. Now you see where we get the discount. It's the difference between the face of the note and the present value. Okay? And so the what? Net note receivable is going to be now this 558036. With me so far? Okay. Now I want to point back something to you that we talked about last time that probably didn't make as much sense to you at the time, but now will make sense to you. Note receivable, valuation and presentation, for financial statement purposes, unearned interest revenue and finance charges are deducted from the face of the amount. This is necessary so that the note will be reported at present value. Does that make a little more sense now? Probably make more sense if I don't cross it out, because for some reason Microsoft can't figure out how to give me a palette where I can just pick from the colors and the highlighters and the things that I want. They can do it in in their Word software. They can do it in Excel, but the one software where you might actually really be doing a presentation in this one, what is it called? PowerPoint, they can't figure that out. Okay, so I'm not sure what's going on. Okay, but anyway, what happens? You sit here, and this makes more sense now, doesn't it? Okay, that you showed it its present value. So we're sitting there, And we're showing that note at its present value, the net note receivable, 658,000. Now what happens? We've got this discount sitting up here. Here we go. Back to the pen. Got to tell it to give me the red pen. Okay, we're sitting here and we've got this discount, don't we? Oh, okay, thank you. So why did I write it here? Oh, I see. That was a different amount. Thank you. Okay, so we've got this one right here, right? Okay, thanks. So we've got this discount. I guess I'll put it here. And we credited it for this 141,964. Right? Okay. And that note, well, that was at January 1st, and the note was outstanding for the entire year, wasn't it? So we now accrue the interest on the present value, right? So we take that 558,036 times 12%. That gives me interest revenue now of 66,964. This is what I loaned the person. I would have taken 558,036 from them, wouldn't have I? But they said, we don't have it. We said, no problem. We got you. We'll let you borrow the money and you just pay us 700,000, right? And so what happens? We're loaning them really 558,036, aren't we? Because we would have taken that cash, so we're loaning them that. So the amount of money we let them borrow was the 558,036. So we multiply that times the interest rate, 12%. That's our interest revenue for year one, isn't it? Right? Okay. Okay, good. So notice, because we're not getting any cash from them yet, we credit the interest revenue, we debit the discount. Now, when we debit the discount gets debited for what? 66,964, doesn't it? That brings the discount balance to, somebody got a number for me? The balance in the discount? 75,000? Huh? 75,000? Okay, good. That brings that discount balance to 75,000, doesn't it? Okay. Then what happens? Then we sit there and we look at the note receivable. I'm going to have to put this on the board because I'm just running out of real estate here on this slide. Okay. But now if we were to look at the note, we'd have the note receivable is still what? 700,000. The discount is now how much? The end of year one? 75,000. So that means that the net note receivable, which constitutes the present value of that note, doesn't it? Is what? 700,000 minus 75,000 is what? 625,000, thank you. Is the carrying value of the note for year two, isn't it? Right? It's the end of year one, the start of year two. I'm not going to pay that off until the end of year two. So now I take the 0.12, the interest for the second year that I'm carrying that note, and that gives me an interest revenue of how much? 75,000, which you can see from the slide here, guys. That's the amount of interest revenue that they take for year two, don't they? So they credit interest revenue for 75,000. They debit the discount for 75,000. When they debit the discount for 75,000, of course, the discount is gone, isn't it? It's now zero. It's now zero. And what? And the note receivable will be closed out as well, right? Because they paid me back, debit cash, credit the note receivable for the 700,000. Question? Question? Are you sure? Because I may very well make you do something like that in the free response question. Oh, no. If it started mid-year, you would take only 6 months of interest for that first year. a full 6 months of interest for the second year, and the next 6 months, assuming a 2-year note, for the next 6 months into year 3. So year 3's interest is going to be the same, going to be more than year 1's interest in that situation, right? Because you pay more interest as as you get closer to the day when you're going to owe 700,000. Once you've borrowed the money, I'm putting it from the standpoint of the borrower, but once you've loaned the money and time has passed, you've recognized the revenue on that, they owe you that much more, don't they? And so now the interest is being accrued on the more that they owe you at that point. Okay? Question? Yeah. Yeah, let's go through the steps. That's probably not a bad idea just because I went kind of fast on that. Yeah, okay, so now that we've seen it once, let's slow it down a little bit. We have this note, 700,000, and they have to pay us back in 2 years. So we look at that as what? Two performance obligations in there. One is the loaning of the money, the other is the sale, right? Okay, the sale we can take immediately, right, at a point in time. The interest part, the money that we're going to earn on the lending, is over time, right? So what we do is we say, okay, what is the present value of that note? You go to that present value table. They said it was 2 years, 12%, right? You multiply it by the present value factor. That gives you the present value of the note. What that's saying is you would have been fine. Mathematics of finance says you are indifferent to receiving $558,036 today or $700,000 2 years from now, assuming a 12% interest rate, right? Okay, and so we break that component into its sale of the merchandise, whatever component, whatever it is we're selling, and what? And the interest component, which we're calling a discount on the note receivable at this point in time, right? That discount is subtracted from the face of the note to give me the net note receivable. Guys, that is also called the carrying value of the note for that year, right? Just like when you take your equipment minus your depreciation, we call that the carrying value of the equipment. Well, here, the face of the note minus the discount is the carrying value of that note. You take that carrying value of the note and you multiply it times the interest rate for that period. That gives you your interest revenue, doesn't it? So we took that 5580, and I think if you did the calculation, it'd be 033, but I just went with the number they gave us here. 036, that's the carrying value of that note. To figure out the interest revenue for year 1, you multiply that by the annual interest rate of 12%. Okay, that gives me the amount of interest I've earned in year 1, and I simply credit my interest revenue for the amount of interest revenue I've earned in year 1. I debit the discount. When I debit the discount comes down, doesn't it, to 75,000? So for year 2, starting January 1st, year 2, December 31st, year 1, January 1st, year 2 are the same date from an accounting standpoint, right? I'm going to go ahead and have the carrying value of the note be 700,000 minus 75,000, like I wrote up on the board, or 625,000. 625,000. You take that 625 times what? Our annual interest rate is 12%, isn't it? That's the interest that I've earned during year 2 on this note, and so I go ahead and I credit my interest revenue, 75,000. I debit the discount. Perfect. Closes out the discount, doesn't it? Discount is gone, and of course now I've collected the cash from them, so I debit cash, I credit the note receivable. Okay? If you learn how to do this, you'll be the smartest accountant on your block. You'll be the smartest accountant in your house, unless you're married to a CPA or living with a CPA somehow. Okay? Question? Okay, good. I have former students, CPAs, they are CPAs, former students that forget this and they'll call me up. You know, they told us it's a non-interest bearing note. How do I do this again? Okay, so this is something that's worth your attention to be able to know how to do this, and so I'm thinking this is the one that I'll give you the free response question on, something like this. Yeah, you want some stars on it? Okay. You want some scary stars on it? Since it's Halloween, I'll put a pumpkin on it. Okay, whatever. Okay. Okay, that's the one that you need to know. Okay. Okay, good, guys. Now, I want to, huh? Oh, darn it. That's okay. I'm not going to do that. Never mind. Since it's not on the slide, we got to move. We got to get through this because I don't want this to wander into next class. Huh? So I can end show though, right? And then I save it? Yeah. Keep? Yeah. And then save? Okay. Like that? Okay. So I'll post that up along with I think it'll be broken into 2 recordings. Okay, good. So we can go to the quiz now? No questions on that? Okay, let's look at question number 1, guys. You're going to see that a lot of these questions come from this CPA software that I borrowed this from. I'm trying to get them to come over here and give you guys one part of the CPA review for free, so you could mess around with that as much as you want. Anyway, I don't want to promise that too quick, huh? Of course. Okay, you talked to me a little bit of that last time, like have a CPA review course teach right here at San Jose State in campus in live class. Okay. Okay, yeah. Okay, great. What's your name again? Ina, if you want to do that, feel free to pass that around the class here or any other classes, I guess. They can't stop you. Freedom of speech. There's no law against it. Don't forget to vote, by the way, guys. I don't know why that slipped into my head, too. Not this week, but next week. By next week, you got to vote, okay? What I'm trying to get them to do, is give away one part of the course. Now, the only thing is it's a little premature for you guys, but since I'm borrowing so many questions from them, I thought it would be good that if we get you that one part, you can go into the database and work as many of the questions as you want, and you get additional batting practice that way. Not to say that that replaces going in and doing the homework assignments in Connect, because somebody asked for more questions, and I said, hey, see the ones in Connect, but that would give you some more questions, too, to work on. So I'm trying to convince them that they should do that, so. Okay? All right, so we'll see, though. I'll work on that. But anyway, so let's go ahead, and I took a lot of questions from the CPA software because the CPA exam loves to ask questions, and that's what got me started. They love to ask questions about the allowance accounting, and so we're going to see some of those here coming up. But let's go sort of in the order that we learned this stuff. What amount should be classified as cash given these factors? Okay, so we're going to have to do a little bank reconciliation, aren't we? Okay, so they give me the bank balance of 150,000, don't they? And then we have deposits in transit. What should I do with that? To the bank balance. I add the deposits in transit, good, for 5,000 because the bank didn't know about those yet, right? Whereas the company did. Now, after you do that, you get a little frustrated. You say, thanks a lot, because they gave you the bank balance. The book balance of 155,000. Okay, but at least you know you're on the right track there. Okay. Now, you look at small bank, and they give me the bank balance, and when they give me the bank balance is 1,500, I have outstanding checks of what? 8,500, and so I'm sitting there overdrawn on that account, what? $7,000. And if you're asking me, why did you write the same thing next to the same thing? Because when I did this question, when I looked at it, I had to convince myself that I was happy with those two numbers right there, right? So maybe you can do that in your head. I don't know, but I like to write it down just to say, okay, I see what they're saying now. They're saying that what? The correct balance is 155,000 for big bank. It's a negative 7,000 for little bank, right? Now the trick here is they're trying to get you, when you look at the choices, they're trying to get you into potentially doing what? What should be classified as cash, and they're trying to trick you into netting those two, aren't they? Is that what you're supposed to do? Little bank, small bank, whatever, is a liability, right? And so my cash balance is the 155,000, right? Guys? Okay. Question? No? Okay, good. So the big trick was there not to net off that negative balance. Okay? Well, we are only looking at big bank because there was a positive balance at big bank, large bank, whatever. Small bank, because they're looking at it by entity. And you do owe small bank money, don't you? So you report that as a liability. You can't net it against those two banks because they're two different institutions, aren't they? Maybe I should point out, remember we said on the one slide, if it was at one institution in two different accounts, then you could net it, couldn't you? But presumably large bank and small bank were two different banks? Yes. Yes. If it was one entity to one bank, two different accounts, then you can net them against, because you really don't owe that one bank money, right? Okay. They owe you money. You have cash in their balance of cash in their account, right? Okay. Okay, good. Come over. That's why my beginning accounting students have a problem when I tell them, okay, when cash decreases, you credit it. And I have students say, no way, there's no way that's the case. Now, first of all, imagine how annoyed I am when they tell me that that's no way that that's the case, okay? But what their problem is they're seeing the accounting from the way the bank describes their accounting to you. They say they're crediting your account. That means that what? They have sat there and they're going to add amounts to your account to money they owe you. They're recording a liability, so they're crediting your account, aren't they? They're debiting their cash. They say they're going to debit your account. That means they're debiting their liability to you, and they're crediting their cash to send you their cash, right? So your asset is their liability. Okay? Okay, good. Now you come over. One time I had to teach a CFA class, Chartered Financial Analyst, and there's a financial portion, financial accounting portion to their exam, and a company talked me into teaching the financial accounting portion of that class, and it was the worst class because I would say stuff like, no, cash decreased, so we credit it. And they're like really smart finance people, and they'd say, excuse me, sir, if cash decreased, why would we credit it? Like I'm a nut or something, and I'm like, okay, I can't talk to you people. Okay, so I never taught that again. Okay, so let's go ahead and let's take a look at this one. Imperial Foods checkbook balance on December 31st, year one, was $122,400. In addition, Imperial held the following items in its safe. I think we had a little exercise that was almost exactly like this, didn't we? Okay, so they're telling us that they have this $122,400 checkbook balance, and then a check for $6,000 received on December 30th, year one, which was not included. Should it have been? Should have been, huh? Should have been included because what? They had it at December 31st, right? Okay. How about number two, a non-sufficient fund check from Star Company in the amount of $800 that had been deposited at the bank but was returned for lack of sufficient funds on December 29th. The check was redeposited in year two. What should we do with that? We're going to subtract that 800 because it didn't clear the bank. The funds weren't there until the next year, right? Okay, so we subtract that 800. So I'll put in parentheses. And then coin and currency, is that part of your cash? Yes, it is. 1,500. It's 1,500 bucks. My dad wants to carry around 1,500 bucks all the time. He says, I don't have any money. And so I go in his wallet, and he's got 1,500 bucks in his wallet. I'm like, well, what do you need more than 1,500 for? I'm going to take this from you, because he loses stuff all the time. He won't let me take it from him. No, I want the money. I'll call the cops if you take it. So I have to. Okay, well, I'll leave it alone. So what does this come out to? 123,700. Good. Okay. Now you think it's funny when my dad says he'll call the cops on me. One time, I'm sitting there, and he says, "Where's my lunch?" And I'm like, "It's in the refrigerator." I'm not gonna go and serve you lunch. Go get your lunch. I'm not here. I'm not your waiter. Right? So I go back out in the backyard and do what I was doing. A little bit later, I come in. It's Hayward Police Department at the door. Someone says they're not being fed over here. So here comes my dad with his big Santa Claus belly, runs in the family, to the door, and the cops go, "Okay, see you later, sir." Okay. Obviously, he's being fed. Okay, all right. Okay. These are the joys of living with an 88-year-old stubborn guy. Okay. All right, number 3. Okay. My dad's other favorite thing to ask me is, what is he paying me for? Which he's not paying me for anything. He said, what am I paying you for? I'm like, what are you talking about? I'm paying you. No, you're not. You're not paying me for anything. If you're paying me, if I'm missing the money, I quit. Now what? Okay, so anyway, that's the nature of our conversation. Okay, enough of that. So we come over, and they want to know what is the what? December 31st balance in the allowance account. Okay, now, the way to analyze these is to set them up as B, A, S, E, the beginning balance. The adds for the period is what? To the allowance, if this is the allowance that we're looking at. The add to the allowance is the bad debt expense, isn't it? Which looks like some of these questions we'll see we'll be asking that. What's the subtracts? Good. The subtracts is the write-offs. Very good. And then you have the beginning balance and the ending balance, right? Okay, so they come out and they tell me that what? The beginning balance is 10.8. Guys? Okay. They tell me that the write-offs for the period were what? 18,000. I know I have to subtract that. And then I'm going to be able to calculate the bad debt expense for the period, which is to take the credit sales that they gave me times what? Times the 3% gives me a little help here. How much? 13,500? Thank you. Okay, so I add 13,500. I subtract the write-offs. Ending balance should be this, what, 6,300? Good. Okay. Now, I show you that first one there, guys, where they were being very nice to me and asking me the ending balance. We could have questions which they'll ask me the bad debt expense for the period, or they'll ask me what was written off, or they'll ask me something stupid like what was the beginning balance, but I can still use that same format and work up or down accordingly depending on what they're asking me, right? Okay, so let's go ahead and let's try. Any question on that one? Okay, let's go ahead and let's look at number 4. And they want the uncollectible account expense. Now, guys, I don't like that uncollectible account expense, but some terminology does call it that. To me, the better name is bad debt expense, but I think in some of the FASB literature and stuff, they call it uncollectible account expense, which to me sounds like a drunk accountant. What's the uncollectible account expense? It's like, you mean bad debt expense? Yeah. Okay, so that's what they mean. Okay, but let's go ahead and let's take a look, and they give me what? Let's do it up here. Beginning balance of 42,000. The adds here are the question mark, aren't they? That's the bad debt expense. The subtracts, did they give that to me? Written off is 46,000. Good. Now, what makes this question, huh? Say again? Yeah, yeah, no, the ad, yeah. When you said the A, I was thinking Oakland A's for a second. Sorry, okay. So, yeah, baseball head. Okay, but so when we have the what? When we have the ads, that's the bad debt expense, which is what we're looking for. And then they give me what? They give me the ending balance per aging is 52,000. Okay. Now the way I like to do these, see how in Word they just give you the pens? See how beautiful that is? Okay. So what happens when we sit here and we're trying to figure out the add, I like to do myself a little subtotal right here. Okay, so my subtotal that I'm going to come up with is 52 plus 46 is 98, like that. Okay, so then I ask myself, well, how would you get from 42 to 98? You'd have to add what? And I do a little side calculation. 98,000 minus 42,000 is how much? 56,000. So I must have had what? A bad debt expense of 56,000. I debited the bad debt expense, credited the allowance. That brought the allowance balance up from its beginning to 98,000. I had write-offs of 46 and ended up with the 52 the problem told me about, right? That's the way I like to think about these. Now, there's probably other ways to do them, but I like to think about them this way. Yes, sir. Oh, you're right. I missed that. You're right. So we've got this 40,000 was already an ad, wasn't it? Yeah, you're right. So I need two suit subtotals here. So I have the 42,000, which was the beginning. I see why you say we knew the ads. And we also know that they added what? Another 40,000. So that brings them up to 82,000, right? And so I went from so what did I have before I wrote off the 46? 98,000. Okay. So the ending balance is what? What am I doing here? I'm sorry, guys. I'm going to have to look here. Yeah, so I need a total of 56 to get from. Oh, okay. Oh, I see. Yeah. Okay, so, yeah. So, never mind that. So, it's the way I said. 42. 42 means I need what? I have a subtotal of 98, and I need another 56,000. Okay, so that's the way I do it, and so this provision, if you're doing it the way I'm doing it, would be useless information to you, okay, because they're asking the total. That's why I like to do it the way I'm doing it. If they're asking me the total that should be added. Now, if they ask me the additional amount that need to be added, then the answer would be 16,000, and you would make this entry that they make here for the additional amount that you need. Okay, but I like to do it the way I did. I know they did it a little different way. I guess they're taking the 40 and saying you need 16 more. I just like to squeeze up for whatever the number is, and the reason I like to do them that way is I know I'm consistent, so that what just happened to me doesn't happen, that I all of a sudden start looking for the wrong number because I get confused as to what it is they're asking me. Okay, so since they were asking me what is the uncollectible account expense, what is the bad debt expense for the period, I simply did it that way to get to what I know had to be the add to the account to fit the rest of the fact pattern, and that's the bad debt expense. So I don't start searching for the wrong number in the middle of the question. Do you need me to do that one again? No, I don't mean you. I mean I know you got it, but I kind of jumped around. Do you need me to do that again? Okay. So what's happening? They gave me the beginning balance, didn't they? Okay. They gave me the ending balance. They gave me the write-offs. So to get, if I subtract 46, I had to have more than 52 to end up with 52. In fact, I had 98, didn't I? So then they gave me the beginning balance of 42. How did I get from 42 to 98? I had to add 56, didn't I? Which is where I go and do that little side calculation to add the 56,000. To add that 56,000, that's my bad debt expense. The amount I add to the allowance for the period is my bad debt expense, my uncollectible account expense. That's what they were asking me. Okay? Okay, good. Come over and let's take a look at this one. This question we already saw. For sake of time, if we have time, I'll come back to it. I realize that I put the same question in the homework as I did in the slides, so refer back to the slides for that if we don't get to that. Okay? I don't want to waste time repeating something we've already looked at. Okay? So let's go ahead and let's just take a look at this one. And again, they want the uncollectible account expense. Okay, so let's see if we can set this one up. They give me that the allowance had a beginning balance of 28,000. Why I put 300, I have no idea. Okay, 28,000. Accounts written off were 23. That's the subtract, isn't it? A lot of times, guys, I just go in order whatever the question's giving me. If you sit there and you try to say, well, now I have to find the add, the subtract, you start spinning your wheels a little bit, right? So I just go in whatever order they give me. Now, they tell me that the accounts receivable were 270,000. And I'm like, well, where's the ending balance to the allowance? Notice they tell me that the net account receivable is 250. So I have to know that I have my what? Accounts receivable, what they said is 270 at the end of the year, 12/31, minus the allowance is going to give me the net accounts receivable, isn't it? Isn't that how we set that up on the balance sheet? And so the net account receivable was the net account receivable was what? 250. So that means the allowance must have had an ending balance of 25,000. So now I know my ending balance is what? 20,000. Sorry, 20,000 right here. And that would give me the 250. Okay, so my ending balance is how much? 20,000? Right? So then I go into my little subtotal mode. And my subtotal I know is 43,000. With me so far? Okay. But what happens? They do have these recoveries, don't they? Uncollectible accounts recovered. Don't I put that back in the allowance? I add that back to the allowance, don't I? I debit the account receivable, credit the allowance when the people come back. Debit the cash, credit the account receivable when they come back. So I got to add that back, don't I? So I take that 5,000 and I add it back. So I got what? I got 33,000 here. I got 33,000. How can I get from 33 to 43? I have to add what? I have to add 10. Good. I have to add 10 more to get in there. To 43. I'm just going to squeeze that in a different color, 10,000. So that means that the bad debt expense for the period must be what? Must be the 10,000? Yes. 43, again, is the logic. If I ended up with 20 and I subtracted 23, I must have had 43 before that, right? If I have $43,000 from an account and I subtract 23,000 to get 20, then I must have had 43, right? Before I subtracted the 23 to end up with 20. So you kind of add those two together. Okay? And then kind of the same logic up here. I start with 28. I add the 5. I had 33. Well, how can you get from 33 to 43? You got to add 10, don't you? And the 10 that I add is my bad debt expense. Right?
Why would the recovery be an addition of 5,000 if they're recovering?
Because when I recover, I reestablish the account receivable. How much did they recover? 5,000. So I debit the account receivable 5,000. I increase the allowance, right? 5,000. To increase the allowance, I credit it because the people came back. Guy hit the lottery. Is that guy that hit 2 billion? He comes and he gives me here's 5,000. I found it with some lint in my pocket, right? So he gives me 5,000. Okay, so I credit the allowance. The crediting the allowance part is sometimes hard for students to really fully comprehend because you're like, well, no, now you put too much back in the allowance. I put amounts in the allowance based on my experience of people who really don't pay me, not based on maybe someone who had a couple bad months and thought they couldn't pay me and then come back later and pay me, right? Okay, so I put that back in the allowance and then I debit the cash for 5,000 and I credit the accounts receivable for 5,000 because the person's actually paying me, but the allowance has come up, right? I have seen some evil questions that I won't give you in which they'll tell you that the journal entry was a debit to cash and a credit to the allowance, which is kind of mean because you're like, well, okay, what happened? It's not necessarily necessary to debit the account receivable just to credit it after I get the cash, right? But that would be, if I'm in practice, I'm doing it, I'm not shortcutting this because this is the kind of stuff that drives people crazy. I would go ahead and do it the long way. Yeah. Okay. Okay. Number 7. Okay, let's do this one. Okay. So this one is very similar to that one that I said see the slides. That's why I didn't do it here for the sake of time, and we'll do it right here. So GAR company received 60,000 6-month 10% interest-bearing note from a customer. After the holding the note for 2 months, GAR was in needing cash and discounted the note at the United Bank at a rate of 12%. The amount of cash GAR received from the bank was, and so let's go ahead and take a look at this. It's a $60,000 note, right? And it has an interest rate of 10%. So if it's a what? 6-month note? So we have to take that 0.10 and we have to multiply that times 1/2 for half the year. And so if they could have waited, they would have gotten what? $3,000 of interest? They could have waited the 6 months, right? So the total proceeds they would have gotten at the end of the 6 months was 63,000, isn't it? Right? So they went to the bank and said, hey, this thing's going to pay off 63,000. Take this and give me some money. And the bank says, okay, but I'm going to charge you interest because now I'm loaning you $63,000, what? For 4 months? Because they held the note for how many months? 2 months, right? So I take that 63,000 now and I multiply that times, and the interest rate that the bank is charging is 0.12, and it's for what? 4 out of the 6 months? Okay, and so when I do the math on that, how much interest is the bank charging these people? How much?
I got 5,040.
5,040? Okay, so that's the interest that they're charging GAR here for getting that money early, aren't they? So the total proceeds that GAR is going to get is what? 63,000. Why is that not looking right? Oh, yeah, it would have been 4 divided by 12, right? 4/12. 1/2 was what? Was 6 divided by 12? Let me write that. 6 divided by 12. Okay, so 0.12 times 63,000 times 0.12 times 4/12 is,
2,520.
that sounds a little bit better, 2,520. So that's the interest that the bank is charging these guys. So they're going to give them proceeds of 63,000 minus 2,520, or 60,000 what? 480? Choice D? Okay. You see the same solution there? Yeah, it had to be. The mistake I made, I did 4/6. It's 4/12. It's an annual interest rate, right? Okay. Okay, good. Number 8. Shoe retailer allows customers to return shoes within 90 days of purchase. The company estimates that 5% of the sales will be returned within the 90-day period. During the month, the company had sales of 200,000 and returns made in prior months of 5,000. What should the company report as net sales? Now remember, guys, we talked about this last time. You're going to reduce your sales by the amount of returns that you estimated based on that year's sales, right? The amounts that go in to the liability for returns are of no, and come out of there, are no consequence of what you reduce your sales for the period by, right? Okay, so just let's look at this. We take the 200,000. I mean, I should have to pay good money for drugs to see something like that. Okay. All right. So you take what? You take the. Oh, how it got way down up there, or wherever it was. Which one? Number 8. And there it is. Okay, I think it should be okay now. So I take the 200,000 times what? 0.05. That means that I have 10,000 sitting here, don't I? Okay. So I will debit my sales returns based on this estimate for 10,000, and I'll credit the what? Good, the liability for returns. With me so far? For 10,000? Okay. Now, the liability for returns, they're telling me over here, they said that what? The company estimates 5% of sales will be returned during the period the company had sales of 200,000 and returns of what? Actual returns of 5,000. So I would debit what? The liability for 5,000 and credit the cash, wouldn't I, when I return those? So the actual return does not affect the what? The sales return contra to sales account? The actual returns did not affect this contra to sales account sales returns, right? Okay. So when I go ahead and I look at my income statement, I'm going to have sales of what? Of 200,000 minus the what? Sales return up here of 10,000. So the answer should be what? 190? Just ignore that nonsense. 190? Okay. Why is it 190? Okay. So the 5,000 is what? Going to be debited to the liability account, not against my sales, right? Now, sometimes students will say, well, wait a minute, They only had returns of 5,000, so that 10,000 is too much. It's too much. What do we call that? Change in accounting estimate. You just leave that balance of 5,000 in there. You go into the next year and you have your sales, and then you might analyze, okay, do I have too much or not enough in that liability account? You can adjust it accordingly each year, right? As you go forward. Change in accounting estimate. You don't go back and restate. Okay? Okay, good. Let's see. We did that one. Let's do, we never seem to have enough time. Okay, let's do question 9. Forget it. We're not going to finish it. And I've got a couple other things I need to show you. What do we got? 10 minutes? Oh, okay. All right. That's all right. Okay. Don't get discouraged. Okay, John. Okay. Now, what happens? We sit here and we have this company sold 46,000 and it uses the gross method. And so if we're using the gross method, let's just do that journal entry together here. What's the journal entry at the time that they have the sale? Credit sales for 46,000 if we're using gross, and debit what? Guys, we sold 46,000 with terms 115 net 30. That means it's on account, isn't it? What do you want me to debit? Accounts receivable. I know. That's like so easy for you. That's like an ant to you now that you just step on and go, oops, right? Okay. So you debit accounts receivable for 46,000. Is that the gross method? Okay. Now what happens? They pay me, it's on April 12th that I do that, and they pay me on June 10th. Did they pay within the discount period? They did not. Discount period was what? 15 days. So what happens when they pay me? They better give me 46,000 of cash so I can credit the account receivable. Right? Okay. On November 10th of the current year, Cherokee Industries sold materials to a customer for 8,000 with credit terms 210 net 30. Cherokee uses the net method. Well, if I'm using the net method, I'm assuming they're going to take the discount, right? Okay. So I go ahead and I take the 8,000 times 0.02, if you want to do it that way. What's that? $160 discount? I take the 8,000 minus the 160. Does that give me the 7840? I could have also, guys, I'm sure you know this, taken the 8,000 times 0.98, and it would have given me the same answer without having to do that extra calculation. I'm of the opinion the more numbers you have to stick into your calculator, the higher the probability of an error. So if you just did it times a 0.98, that might be a less risky way to do it. But I'm going to record it net. I'm going to debit the accounts receivable, credit to sales. Net. Okay. Okay, same fact pattern. And what happens? They pay me on November 17th. Did they pay me within the discount period? Yes, they did. So I will simply do what? Debit the, is it gross method or net method? So I'm simply going to debit the cash, credit the account receivable when they pay me. Choice A, right? Debit the cash, credit the account receivable. Here I debited the account receivable. I credited the sale. When they pay me within the discount period, I debit the cash, I credit the account receivable, right? Okay. All right, good. Now I come over, and what if they pay me and they make the payment on December 10th? They did not pay me within the 10 days, right? So they lost the discount. So I know that they're going to have to pay me the full cash, 8,000, right? They're going to credit the account receivable 784. It's not called discount revenue. It's called what? Discounts lost or something like that, which is what, this choice B? Okay. Okay, maybe we're going to get a little further than we thought. We should be able to do this one. We'll do the next two, and then we're going to call it off just so we don't overcram our brains. And anything that's left, we'll do next time. Should only be a couple, okay? But let's go ahead and let's take a look at this one. False hardware offers an unlimited, no question asked right of return on all products. False value hardware began 2018 with a credit balance of $32,000 in the refund liability account. Sales and cash collections from the customers were $650, which is important. Cash collections are irrelevant. It does not matter. It does not affect the amount that I need to put in for my returns or not. Doesn't matter. Because they could pay the cash and still return the stuff, couldn't they? Right? So that has no effect. Okay? False value estimates that 6% of all sales will be returned during 2018. Customers may return merchandise for a credit of 28,000. So what's going to happen? I'm going to sit here, you can see the answer already, but I'm going to sit here and in my liability, I started the year with what, 32,000? And then during the year, I added 39,000 to that. You can see that right there. The sales times the 6% that I determine is going to be returned. And then what happens? When the people actually return the stuff, I debit the liability for what? 28,000, and just to complete that, journal entry, I go ahead and I debit cash. I credit cash for 28,000. Right there. So the balance in the account is going to be 43,000. Right? Hang on, one more. Don't start looking for something else yet. Right here. Because these two are connected. Right here. Okay, now what happens? They give me the same fact pattern, but now they want me to report the net sales on the income statement. Well, what was in the beginning balance and what actually got returned during the year is of no consequence, right? I debit that sales return account, don't I? And I credit the liability. Okay, and that's what's reported on the income statement. So I simply have to take what? I have to take the sales of 650,000 and I simply reduce it by what was added to the account for the year, which was this 39,000. Right? And that gives me what? 611. Okay. Okay, we'll deal with the interest ones. It's almost like kind of almost went the way we did it in class, where we went through the slides first and we stopped at the interest. So we'll do that again with these. We'll pick up the interest next time. We'll start on chapter 8/9 next time. I will also be putting the homework assignments in Connect for chapter 7 and the slides up for 8 and 9, and I will be putting up the research project that I want you to do. If you didn't sign in, please do so. I will see you on Monday. Have a good weekend. Be safe tonight.